Kinder Morgan, one of the largest energy infrastructure companies in North America, has just reported their year-ending results, and we saw a approximate 2% decline in the stock, meaning they still haven't recovered back to those 2020 highs nearly 3 years later. Not something that would entice the typical value investor to come in here and buy, but we still have to analyze this business to see if there is some hidden value that maybe the market is missing. So with that in mind, we value investors have to ask ourselves if this really is the perfect chance to buy and pick up shares at a steep discount, or if the stock will end up heading lower for longer. As you can see from this long-term historical price chart, things are not looking amazing from a technical perspective, which usually alludes to poor fundamentals. But if there really is some hidden value here, this may actually be an investment of a lifetime with a 6% dividend currently. So make sure to stick around to the end of the video as we're going through all the details and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today, we are going to analyze this business's financials. We'll start with the fundamentals, go through the business and where it's heading in the future. Finally, we'll end up concluding this video off with an intrinsic value calculation to see where the buying points are for Kinder Morgan. And as always, if you do enjoy this video, make sure to smash that like button and subscribe, as it really helps out the channel. And due to the fact that we post on here regularly, analyzing the businesses that you are most interested in, as always, leave a comment down below on the next sector or stock that you want to see analyzed. But with all that out of the way, let's jump into the video. All right, so looking at Kinder Morgan's fourth quarter year-ending results for 2022, what did we see here? Well, revenues came in at about $4.5 billion, a 3% increase year over year, missed estimates just by a little bit, and they came in on par with their earnings estimates here. They also mentioned that they are going to be authorizing another $1 billion worth of share buybacks. So that's something that potential value investors and current stock owners will be excited about, as their shares will have another $1 billion of value added to them. Let's immediately jump into how they did this quarter. As you can see here, as we mentioned, $4.5 billion. Compare that to last year, this time $4.4 billion, just that 3% increase in revenues. After we deduct for their cost of sales, operations and maintenance, depreciation, etc., they have total operating costs of about $3.4 billion, means that we're left with only $1.1 billion in operating income. But that is an increase to the bottom line there when we compare this to last year's results. For the full year's perspective, we had about $19 billion in revenues, a nice $3 billion increase there from 2021. When we add up all our operating costs, we're left with $15 billion of costs there on those revenues, which means we're only left with $4 billion in earnings from operating the business. You know, a nice $1.1 billion increase from last year. So there is a decent amount of growth here from this business. Let's dive a little bit deeper and see what's actually going on behind the scenes. Well, if we look at this chart here from today's video sponsor, Main Street Financial Data, the first link in the description, they're really helping us value investors discern key fundamental data that helps us make informed investing decisions. And so if we look at this chart here, as you know, they produce their revenues from their net oil production here that has actually been on the decline over the past few years, right? So you might be wondering, why is it that if their net oil production is actually decreasing, you know, their profits are actually increasing? Well, the answer to the question you're wondering is because their oil and natural gas prices have been increasing. If we look at the prices back in 2020 and 2021, they were down at, you know, almost $30 per gallon. At the peak of 2022, they were up at $40 or more, at least in terms of their natural gas liquids. They have tapered off slightly down to like $35 per share, but that is why they're able to sell their products at higher prices. Of course, that is going to have a positive impact on their revenues. And the same thing goes for the oil prices. Those were down at $50 per share back in 2021 and 2020. Now they're up to nearly $65 per share, a massive increase. And so they're going to profit on the back end from that. But this is what you have to understand about these energy and infrastructure businesses. They're naturally cyclical, meaning they are definitely going to have times when they're going to be profiting, and then there's going to be down cycles as well, where prices are going to be declining and then they won't be making as much money on the back end. That's usually the best time to buy, not when oil prices and natural gas prices are, you know, at high levels, because you can always anticipate that cycle will always reverse at some point. All right. The good thing though is that on a relative basis, they're able to keep their costs relatively flat year over year. And that is a good thing. That means when there is that positive turn in the cycle where prices are increasing, you're going to really profit, as your costs are going to stay the same, but your prices will increase, meaning you'll profit more on those revenues. Conversely, when down cycle happens, those costs are going to relatively be the same. It's just that your revenues will be a little bit shorter and margins will be a little bit thinner. So if we look at this balance sheet overview produced by Main Street Financial, we can kind of get an idea of what's going on in terms of the balance sheet. But I do have a little caveat to mention here. It's that if you see this little red bar down here in this corner, That's actually the amount of cash that they actually have on the balance sheet. The rest of these assets are actually considered like property and equipment, things like that. And naturally, a business like Kinder Morgan is going to have a substantial amount of that. That also includes goodwill and things like that. But something like goodwill isn't really a tangible asset. And if we were in a pinch for this business, we can't really use goodwill to pay off debt. So if you look at this from a cash perspective, just about less than $1 billion in cash on the balance sheet versus about $30 billion in debt, which means this business is quite levered at this current point in time. Definitely something that should be concerning investors. They're at a 3.9x net debt to adjusted EBITDA ratio. So if you're thinking about investing in a business like this, that's something you definitely have to keep in mind. If things do turn sour, they're definitely going to be in a pinch there. When it comes to free cash flows, those have been growing up to about $4.4 billion last year. That is good. They're looking to reward shareholders with those dividends and now also buying back shares so that your shares become more valuable. And in terms of the future of this business, they're expecting that by 2030, the United States should be the world's largest natural gas producer. I mean, they already are in 2020, but they expect that to continue further. And Kinder Morgan will be right in the center of that, profiting off that oil and natural gas production. They do have a proven history of cash flow generation. You know, if we look at this from 2016 till now, they had about an 82% increase in free cash flows. Those are strong numbers. Net debt was also decreased about 18%, and they did increase their dividend over to their shareholders as well. So, I mean, there actually is some hidden value with this business. You just have to kind of understand and make that decision on whether or not it's enough for you to come in there with a business that is still down about 50% from its all-time high, you know, years and years ago. I mean, the management definitely recognizes that they do have some issues here, especially with debt. They are trying to decrease that number there, increase the free cash flows, reward shareholders that are being loyal and sticking with this stock. So definitely something to think about there. In terms of their guidance, they're saying they're going to come in with about $8.2 to $7.7 billion in operating income for 2023. They do have a bunch of growth projects in service. They also partake in quite a few joint ventures. So there is actually some good things going for them. But again, they're still expecting that, you know, year-ended net debt to adjusted EBITDA figure of 4x. So just a little too much for my liking personally. Now, finally, once you look at this last chart here, from Main Street Financial Data, we can look at their operating income over the past few years. It really likes to fluctuate between that $4 to $2 billion mark year over year. So you can expect in good years, it'll be up and around that $4.5 to $5 billion range. Then in bad years, it's down to like 1.5 or less. So if we expect that in an average scenario, they can produce about $2 billion in operating income. If we expect a 10% return on our investment, they do pay a 6% dividend. And if they can only stick to their 5-year growth projections here of about 5%, you know, stabilizing out at just 3% for the 5 to 10 years after that on a 16 PE like they're currently trading at, the stock should only be worth about $15 per share in a normal case scenario. Right now, they're trading at about $18 per share. So a little bit of downside from this current point in time for a very conservative investment. If they were to cut their dividend for whatever reason, you know, there's more hardship in this business, we can see how that affects these prices here down to $8 per share without that 6% dividend. So that's why that dividend is very crucial to keep investors into this stock. Now, in the very best case scenario, let's say they can really ramp up production while also lowering their costs for their primary business. You know, let's say they can grow at, let's just call it 10% for the first 5 years. That drops down to about 8% for the 5 to 10 years after that. On a 20 PE, the stock should be worth about $25 per share. A little bit of upside from where we are currently, but for a very optimistic scenario here, you'd really want that number to be a lot higher. You'd expect that this business could do more than that, but there's actually something we're missing here. It's that we're not even taking into consideration the amount of debt that they do have. That should also lower that number as well. So right now, at least from the normal and optimistic scenario, I do think this business is a little bit overvalued right now once we consider the amount of debt that they do have on the balance sheet. I know why they are priced the way they are. It's simply because of how strong the fundamental business is. Despite declining delivery volumes, this is still a huge business in North America. We mentioned it's one of the largest infrastructure businesses, so very important business. But again, let's look at this from the worst case scenario here. 0% growth, let's just say for the next 10 years on a 10 PE, yeah, the stock would be down to $9 per share. Again, if we cut that dividend for any reason, yeah, you can anticipate there will be a lot of selling for this business. You know, we were up to all-time highs back back in 2015 at $43 per share, but like I mentioned earlier, we're about 60% down from those levels, and we're not really showing any signs of recovering any of those gains. So investors that bought up here are really holding the bag down here, especially with the amount of debt that they do have on the balance sheet as well. It's going to be a tough ride for them to recover, but there is a nice dividend that you can hold on to. And despite the cycles, they're not really going below $15 per share. So make an investing decision on that front. That's the analysis from my point of view for Kinder Morgan's Q4 earnings results. If you made it this far in the video, make sure to like and subscribe as it really helps out the channel. Make sure to check out the video sponsor, Main Street Financial Data. Again, first link in the description. And always make sure to comment your thoughts down below on whether or not you think this is a buy or a sell, and if you want to see any other videos in the future. Again, I thank you for watching, and I'll catch you on the next one.